And like I said before, when you are doing the practice question, review the answers, both right and the wrong ones. Because what that will do for you is that it will enable you to understand the rationale, okay? To enable you to understand the rationale. And I also did mention last week that field training along with this study you are doing is what is going to help you a great deal. Like today now that we are talking about application process and everything. If any of you have taken the initiative to book appointment and I help you and I go on the appointment with you in the course of the week, you see this application, it will be crystal clear to you how it works because you would have seen it, in practical. So as you're doing the study, alongside with practical, I will recommend strongly, okay? And that practical is your field training. And that field training is when you book a meeting. And how do you book a meeting? It's very easy. You, first of all, make a list. Make a list of people that you know, right? Your friends, your close friends, we call that process your warm market. And then let's say, oh, Cheryl is my friend. I called Cheryl. Hey, Cheryl, how are you? Cheryl, can you unmute yourself and role play with me real quick? So I know the people that ask. Cheryl, are you there? Okay, let me go with me, Tope. So, Tope, how are you? Good morning.
Yeah, good morning. How are you, Joy?
I'm doing
okay?
fine, thank you. How is family and work?
We thank God that we all is okay. We
Awesome, awesome.
doing all right.
You know what, Tope? I recently started my business, something that I'm doing on the side to earn extra income. I'm still in training, and my executive director is the one training me for my practical. I need your help for you to come on Zoom so that my executive director will do a presentation to you while I watch and learn, so that subsequently I can be able to learn and do it on my own. It will take about 30 minutes. Will you be able to help me with that?
Yeah, I can definitely try and work on that to see how we can.
Awesome. Thank you very much. I have availability for like weekdays, 6 o'clock, or weekends, 4 p.m. Which days of the week or Saturday or Sunday do you think might work for you?
We can work with the 4 p.m. on Saturday.
Lovely. I appreciate that. So I'm going to confirm the meeting with my executive director and I'll send you the meeting details. Thank you.
Thank you.
So, guys, you see, is this difficult?
It wasn't difficult. It's just sometimes we kind of get into kind of a gridlock with you know our
Yeah.
environment, sometimes our community, but that shouldn't be a problem. Like my brother actually brought me along to Agosu about
Uh-huh.
having to know this, and we spoke. Okay, let's go there. Let's go see what's going on. So
Right.
that kind of stuff. So that's my friend. So and we're able to work together even at this point in time. So
Mhm.
and I think things should be like that moving forward too. But
Yeah, you are right. But one thing I'll recommend is that you see at the initial stage, people want to ask you, oh, what is this all about? Tell me about this business or whatever. But you have to be discreet because when you get into trying to explain, that's when it goes downhill from there. Because you start saying, we sell this, we sell this, we sell this. But whereas it's not so. You understand? You see, what we are in the business of education, we provide learning. You see, like for those of you in the meeting yesterday, all the information I unpacked yesterday, was there a time I came across like I was trying to upsell or sell anything to anybody?
No.
But so much information was given that anybody that mean well for themselves will think about it and want to take a step towards, either acquiring one of those solutions for themselves. But even when we meet with people, right, and they are not interested in taking on life policy, saving for their kids, that's fine. We ask them, do you know somebody else I could talk to? They can give us referral, right? So this is what I would recommend for you guys to look into in this coming week as we go through this program to align it with practical. Use this role play we just did to book a meeting, okay? And I'm going to share my calendar in the group so that once you've spoken to somebody, you don't need to call me. Just go straight to my calendar and book the meeting. But talk by you and um is it Amos the second person, right?
Yeah, it's body.
Yes.
Yeah, it's something as
Yeah.
body.
Sorry, Bode. Yes.
Yeah.
So you guys can book Noreen, okay, because he will do your field training for you, okay?
Okay.
Yeah. Okay. So for the rest of you, go straight to my calendar, book it. This application, you want to see how it's done real life. You will never forget it. And there's no way the exam will come when you've done it real life. You've read something, you've done practical. Oh, my goodness, it's settled. You know it. Okay. And it's not a big deal because eventually this is what we're going to be doing on a regular basis. Sometimes as I'm taking class teaching now, and I see some of the things that look so far, like so big of a deal when I was studying for my exam. I'm like, was it this thing that was so, now, like I just do it like normal life. Okay. So that being said, let's write on a quick cap a quick recap of what we did last week. Last weekend, we were able to cover a whole lot of grounds. Okay, we talked about risk, we talked about life insurance, different types of life insurance, from chapter 1, to chapter 3. And then in chapter 4, we dive right into universal life in details. Okay. And in all these policies, we talked about how the premiums are calculated. Okay. In what ways can we withdraw our money? So all those things we discussed from chapter 4 last week. Then we move on to riders that provides additional benefits. And if you've not watched that video, I talked about the fact that riders is like toppings on top of pizza. So you have the base, which is the main policy, then the riders, like you go buy pizza, you say, I want extra cheese, pepperoni, blah, blah, blah. Those things are topping. Riders on themselves are not standalone policy, but they had to stand on something. Okay? So those are that we covered in chapter 5 for riders and supplementary benefit. Then we moved on to chapter 6, where we learned about how group life insurance works. And that was so cool because for those of you that are working and in your organizations, you have life coverage from your organizations. So understanding how the group policy works, the limitations, and all that stuff is really good. You see, I'm so excited about the information you guys are getting through this program. And that's why I tell people, even if you don't want to even do this business, get this knowledge, it will help you a great deal. And from there, we move on to chapter 7, where we talk about taxation. The taxation of life insurance policy. How does it work? Yes, the death benefit is 100% tax-free, but in between your growth, what can you do to avoid those taxes? You see, because it doesn't, when we say 100% tax-free, it doesn't mean that there are not elements of tax implications. But if you know what to do, then you won't fall into that tax implications. Those are the things we learned in chapter 7. Then we move on to chapter 8, which talks about business life insurance. You see, this one is a fantastic value proposition for business owners, small business owners. We talked about key person insurance. We talked about of buying rights, crisscross arrangements, and all those kind of stuff. So yeah, please watch the recording. It's well explained. It's very, very well explained. And then do your quizzes. And this morning, my people, we are moving on to applications and underwriting. So application and underwriting, this one is going to be a very quick one. So when we talk about application, what is application? What is underwriting process? Okay, the underwriting process is a process of where insurance company uses to assess the risk potential of life insurance applicants. Because when I talk about risk yesterday, for those of you guys on the call with me yesterday evening, you see, we talked about risk. We talked about four different risk management system, and all that is in your either chapter 1, 2, or 3, or so. You're going to learn about those risks. But when you are transferring your risk to the insurance company will want to know, to what extent is this risk that we are undertaking? That is what we call underwriting process, okay? And if so, the premium that needs to be charged to insure it. You see, sometimes when the risk is higher, the premium might be higher. Like somebody that is a smoker. You see, a smoker pays higher premium than a non-smoker, right? As a general rule, the higher the risk presented by the life insurance applicant, the higher the premium that will be charged to the to insure the risk. All right. So now we move on to, as a general, okay, we talked about this one. Now, underwriting is completed at head office level. But agents, the agent, we are the one that starts the underwriting process. And how do we start the underwriting? We say, who am I? How could it be me? We start the underwriting process by different level, okay? Insight and observations are important, okay? And then the agent is sometimes called the eyes of the insurance company. You see, that's why the insurance company don't joke with us. And when they pay us big money, because they value that what we do is critical to the success of their business as well. Okay. Now, typically, only the agent will have face-to-face contact with the insurance applicant. All right. Now, underwriting is completed for both personal and group policies. Now, what is our role as an agent in this whole process? Our role is to collect some of the information that needed to assess the risk. All right. And that information is supplemented by other sources consulted by the underwriter. Okay. Now, completing their applications, as agents, we ensure that information on the application is complete and accurate. The applicants understand what will happen if the information is incomplete or inaccurate. The identity of the applicants and life insured is as stated by the comparing name, date of birth, and what appearance against government issued ID. Signatures are true by witnessing the signature on the application. Okay? Da, 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 da. Okay, now the application is complete when all information needed has been provided and the application is signed by the applicant and witnessed by the insurance agent. The agent's role is in helping the client complete the application, is sometimes referred to as field underwriting. So I want to bring out an application document here to show you guys. Can you guys see this from one of our partners? Okay, this is when there used to be Hllqp, but now they are called Beneva. See, so you see there are several pages. This application document is about 32 pages. Okay, but you don't need to freak out. It's not all the section here because this is a standard application they use for a lot of stuff. It's not all the everything. Yes, so for me, you can see that I sticky in this area. I did this when I had this since I started this business. You can see it's really old. And I use this. This is like my templates, right? And I put those stickies there to tell me, okay, these are the sections that I need to complete. That way I don't need to be reading all the sections, right? But I don't do that anymore because right off the back, I know what I'm going to be doing. But these are the information, let me just go through a few of them just as an example, all right? So we have name, first name, last name, date of birth, place of birth or country of birth, right? And then your date, you have the day, the month, the year, and then when you arrived in Canada, if not here, and then are you Canadian citizen, permanent resident, then address, residential address, email address, phone number, postal code, and then we move on to employment details and stuff like that. So those are the kind of information you see in the application document. So when you do field training, if I go on field training with you now, then we get to complete this real time, then you see how it works, okay? Now, underwriting. The completed application is sent to the underwriting department. So when we complete the application, it doesn't sit with us. You see, and that is why I showed you guys the back office yesterday. Those of you that have sat with one-on-one, I've showed you guys the back office because we don't do anything paperwork. Everything is complete online. Some of these insurance companies, they have online application. The ones that are not online, they have the PDF online. Then we download it, we complete it. That is fillable PDF. You just fill it on your computer, send it to the client through DocuSign. The client sign, you sign, and then we just upload it to Experior back office. You see, those are the things that our $37 every month does for us. And the more you start using the platform, you're going to have great appreciation, you see, in that back office, okay? Now, the completed application is sent to the underwriting department, and the underwriter initially assigned the life insured the mortality risk of an average person. Mortality risk, oh my God. You can see how everything is tying together, right? I'm not going to start explaining mortality risk. You understand me? When you go through the previous classes, I break it down there. I explain it. All right. And that's why, catching up before the next class is always helpful. All right. And then we move forward. You see, the underwriter then compares the life insured against many medical, financial, and lifestyle criteria. The purpose of the comparison is to assign the life insured the most appropriate risk class. Okay, so this step now is done at head office. All right, these steps, it doesn't take so long because sometimes we submit policy by weekend like this, and then by the following week, midweek, Wednesday, Friday, we've gotten approval. The process doesn't take time at all. In the comparison, if the comparison shows the life insured has a low mortality risk and the application is for a standard amount of insurance, then a policy is usually issued quickly. It's when nothing is happening, the person is good. Like approval can come within a day or two. Now, if the comparison shows the life insurance has a higher mortality risk, or their application is for a non-standard amount of insurance, then a decision about whether a policy will be issued is not made until additional information can be accessed. Okay, now issuing and delivering policy. Now, this additional information that will be accessed could be medical. The insurance company will now send you, we have a portal. Okay, I can't go and start showing you guys now because those are the things you see during your field training. Where do you go to get updates from the insurance company? Because we talk directly with the insurance company. When it comes to update on policies, there's a portal we go. You now see update on this policy you've submitted. Then the insurance company will tell you, okay, book a medical for this person. Then we know how to book the medical. The medical doesn't cost the client any amount. Then we book it. The nurse will go to the client's house. Then they'll complete the medical. Those constitute those additional information. And then additional information also means that the insurance company will also go into the medical information bureau of the client to have in-depth understanding of their medical history. Okay? Issuing and delivering the policy. So this section is exam question comes from this issue and delivering policy. So I need you all to pay good attention. The agent personally delivers the policy again to the policy holder. You see this one? Not anymore. Because why? We deliver policy now even on Zoom. Okay. Now, before, the insurance company will mail the policy to us, the agent, and we, the agent, will now go to the client to deliver the policy. But now, the insurance company mail it directly to the client. Okay? And then we now go over the policy on Zoom with the client. Okay? Now, the agent continue the underwriting process by ensuring the medical, personal, and financial status of the policyholder and life insured have not changed since the application was made. This is very important because you see, when we complete application, sometimes it takes days, sometimes depends on the level of the in-depth further inquiries that the insurance company will have to do. So that might lead to maybe gaps. So now, upon delivering this policy, as an advisor, we need to ensure that, and all these things is not something we ask from our head. There's what we call policy delivering documents. Okay, so those documents have questions that will ask clients, okay, since we completed this application, have you had any medical, has any change with respect to your health, your finances, and all those things? You see, those are the questions we ask during policy delivering process. Okay. 1 second here. And then policy was made. Did I go back? Is this not going? 1, 3, 4, 35 on the writing. Okay. What's happening now? The application policy details. Wait. The insurance company determine whether they. Every time I move to the next page, this thing has a way of jumping on me. Now I'm looking for where I stopped. So guys, just bear with me, bro. Okay, ahead of this. We've done all this. Agent role. Yeah. Completing application. When did I go back to all these places? Then underwriter initially assigned line. Yeah. Aging and delivering policy. Okay, this is where I was. Now, the agent must not deliver the policy if there's any indication of a change between applications and delivery. Okay, so now when the policy is ready and you are going through these questions with the client, and the client said, oh, by the way, I went to my doctor yesterday and my doctor, or I wasn't feeling fine and some tests were run and we are waiting for the or whatever. So agents should not deliver the policy. Okay, so the agent until application and delivering can be assessed. Okay, so that those new development can be further assessed. All right, issuing and delivering policy. The agent personally delivers the policy to the policyholder. I think it can be made. The agent must not deliver. Okay, this is what we just
this is
covered.
real.
Yeah, okay, application. So the agent helps the application to complete the applicant, sorry, to complete the application. Spending time with the applicant may reveal aspects of the individuals that are not apparent from the writing form. The agent will want to share any information that can affect the risk assessment with the underwriter. Okay, so when we are completing application, basically what I do is that I just sit down over Zoom and I go over the questions with the client. And sometimes clients are busy. I have all the necessary questions in these applications. I have it ready. I send it to the client. They send me the answers. Then I use it to complete the distance. But once I'm done, I go over those things during the time of them signing. Okay, policy details. Well, an application typically begins with type of coverage the applicant wants to receive. And all this type of coverage, these are the things we uncover during the course of our EFA, expert financial analysis. We don't just assume, oh, Mr. A, you have 5 children. Your house is, fully detached. Okay, your coverage, 500,000. Oh, Mr. B, oh, you have only 2 children. Your house is it semi-detached? What do they call that one? 300. I think 300 would be enough for you. 300, yeah, 300. No, that's not how we do it. We do a proper needs analysis. And how do we do those proper needs analysis? Through our expert financial analysis software that you have access to in your back office. Okay, so now everybody, you see, okay, here's what we are going to do. All of you, go on my calendar after this meeting, book yourself, book meeting, so that let's even start with you yourself. Let's not even keep it until you. Yes, go ahead, try and book meeting for other people, but I want to start with each of you first. Let's start with you, because by the time I show you, I walk you through your back office. Okay, this is, then I will guide you, you do your own EFA by yourself. Then we run this illustrations of life insurance application process for you by yourself. How about we start from that? I just thought about that, right? Okay, now moving on. The applicants, I need to move fast, I think. The applicant is the person who wants to buy the policy and who will be the future policy holder if the policy is issued. So they just define applicants and policy holder for us, okay? When the applicant will not be the life insured, then the name of the contingent or successor owner is required. So all this now, you say applicant, policyholder, we've broken it down in the previous whatever. Successor policyholder, we've talked about all those things. Okay, we're not going to spend too much time. And this owner becomes the policyholder if the original holder dies, okay? Then we talked about life insured, they're explaining life insured for us here. We know who life insured is already. If you have, don't worry, as you go through these classes, you're going to know, okay? Now, the applicant must identify a specific person as a life insured, okay? An applicant may or may not be the same person as the life insured, but in most cases, the applicant will also be the life insured. A joint life policy names two life insured and must further specify whether the death benefit will be paid when one dies, that is joint first to die policy, or joint last to die. Okay, don't worry about joint first to die. You let that when you catch up with us. Okay, now let's talk about beneficiary. We've already talked about beneficiary in the past, but let's quickly fly through it here. The beneficiary receives the death benefit when the life insured dies. Okay? And the beneficiary can be the applicant, any other individual, a group of people, or a trust, a business or a charity organization. However, note that the applicant may only be the beneficiary if they are not the life insured. So you cannot be the life insured and it doesn't make sense, right, guys? You can't be the life insured and the beneficiary at the same time. Okay. Now, when a beneficiary is not named, proceeds are paid to the estate of the policyholder. Okay. A contingent beneficiary can be named who will receive the death benefit if the original beneficiary has died. Beneficiaries can be changed by making a written request to the insurer. The exception is when the beneficiary is irrevocable beneficiary. So I'm going to dwell here a little bit to break these different types of beneficiaries to you guys. Okay, because you're going to see it in your application and you will see it in the exam. Okay, now an irrevocable beneficiary cannot be replaced unless the beneficiary give their permissions. This is the situation whereby the person that is a beneficiary is the one handcuffing the owner of the policy. And you'll be wondering, Joy, how could that be possible? The owner is the owner. Therefore, who, it's like, who the, the person that is being helped is now the one detecting the tone. Well, there are situations like that, right? And then revocable one is the one that the owner can change at any time. You can wake up, you don't like the face of the person you've named as your beneficiary, or due to relationship reason and everything, you can just written whatever said, I'm changing my beneficiary. But if it is irrevocable, you cannot without that beneficiary permitting you to do so in writing. Okay. Types of policy. One application may serve for many types of policies. The universal life applicant may have additional choices to make on the application to select how mortality deductions will be calculated. For example, yearly renewable terms, okay? Both UL and whole life applicants will usually be provided with documents that contains an illustration of policy benefits. Okay, yes, we talked about all this and yearly renewable term, all those stuff. Session that correspond. Okay, now the UL sale illustrations project values for the deposit. Again, this part will make more sense if you've seen a universal life illustrations, because you will see the value, this cash value and all those stuff, you will see it. Okay, you see the investment, all right? Same as whole life illustrations for participating policy product dividend, all right? Now the illustrations that corresponds to the application must be attached to the application and signed by the applicants to demonstrate that the applicant has been shown how the policy works. Okay, so we're moving on to riders and supplementary benefits, how it's done on an application. Okay, so what this is telling us is that, you see, with term insurance, there's no illustrations that goes with it because that is just a bare-bone policy coverage. But with the permanent insurance that have investment component to it, we are mandated, to show clients the illustrations that demonstrate the cash value, the growth, and all that. That's what this is talking about. All right. So 5925. Need to start moving faster now. Okay, so here we are talking about riders and supplementary benefits. Okay, if the insurance company allows policyholder to select additional rider and supplementary benefit, such a family coverage rider that is in bracket. Okay, again, like I just mentioned earlier, now that riders are not just a standalone policy on their own. They are toppings, like on your pizza, right? So those toppings sometimes we may take riders and supplementary benefit to cover children, to cover certain things, maybe critical illness rider or whatever, paid up addition rider or whatever rider it is, okay? Typically, additional riders and benefits may also be selected when policy is issued. So that needs to be shown on the application, okay? Now, another thing that we show on application is premium options, okay? So the payment schedule must also be shown on their application. And this premium schedule could be monthly, quarterly, semi-annually, or annually, okay? So we need to indicate this in the application. Then we move on to dividend options, and this is applicable to whole life policy that pays dividend, okay? That is PAR policies. So with PAR whole life, policies have a choice as how dividends will be received, and this choice is made on the application. It could be in cash, it could be premium reductions, accumulation, paid up additions, or additional term insurance, okay? So another information we get to see on the application is information about the applicant, okay? Now, the information about the applicant could constitute the attention of the insurer, is what brings attention of the insurance company focuses on the applicants for their ability to pay premium. All these are information about the applicant that we show on the application paperwork. The name of the insured. Now, the insured interest, right? Then what is the insured interest? Because if you are taking policy on somebody, you that is the policy owner, what is your insurable interest in that person? Why do you want to take policy? So that's why we can't just wake up and go and take policy on a random person. Otherwise, we will all be walking around not knowing that some people are taking policy on our heads, right? The jurisdiction for the amount of coverage. Which province is this person residing? History of insurance applications. Has this person been denied insurance application before? The another information we show on the application paperwork is financial abilities. To be assured the applicants can afford the premium, the application may request details of the applicants, such as their occupations, are they retired, are they employer or employee, what are their income sources, what are their net worth, okay? Now, insurability interest, that's what I just explained now, as insurability interest in a policy requirement. It exists when the death of the life insured will cause the policyholder to suffer a financial loss, okay, or fail to make a financial gain. Therefore, the policyholder needs to have an insurable interest in the life insured, okay? An insurable interest is created by a policyholder who is also the life insured and who will suffer a financial loss by their own death. Therefore, they have an insurable interest in their own life, okay? So we move on to, okay, here there's a note here that the insurable interest must only be present at the time the policy is issued. If the relationship between the policyholder and the life insurance changes such that the insurable interest no longer exists, the contract is still valid. Okay, for example, if a man take a policy on his wife when they were married or whatever partners, and that relationship has broken down and they've gone their separate ways, that policy still stands. So if the other person dies subsequently, that policy, the other one that took the beneficiary will still get paid. Okay. So there's an example here. I always tell you guys to go read the examples. Okay. Now, jurisdiction of amount of coverage. Sorry, justification amount of coverage. Okay. Insurance is intended to restore the person who has suffered the financial loss due to death to the position there. Um, they will otherwise enjoy if death had not occurred. Insurance is not intended to provide a way for a person to profit from the death of the life insured. So the amount of coverage must be reasonable for the circumstances of the policyholder and beneficiary. And we'll see that in this example. What this is speaking to is that, and we don't need to worry about this because when you do your needs analysis and that's why we do needs analysis. And that's why we do EFA, right? Expert Financial Analysis. So yeah, read this example here, okay? Insurance application history. That's another information they ask us on application. Underwriters will also consider other policies that exist or which application has been made or has been denied, wherever. So has this person have any other insurance coverage in existence? Or has this person have policy denied? All those information is asked in the application process. Personal information, of course, our personal information, like the one I just read to us briefly at the beginning, such as the name, date of birth, address. Initially, we used to ask social insurance number, but I noticed that the new application document from Beneva don't ask for social insurance number anymore. Country of birth, nationality or immigration status, employer and occupation, details of bankruptcy, all this information. Okay. And then we'll move on to lifestyle, hobbies, travel, smoking, alcohol, driving, diving, criminal charges, or any convictions, all that we ask. Move on to medical information. Yes, we ask medical information, even though some people are not comfortable with this, but we assure them that it's for the purpose of this. But when people are not comfortable to give us their medical information, that is okay. So typically what I do is that I put a note there and I put their contact there. I'll submit the paperwork. The insurance company will call them to ask those questions because sometimes when you are close to people, they are hesitant, to tell you details about their health situations. And I respect people a lot when I sense that. So I tell them, don't worry, we'll finish off, get the necessary signatures, and then the insurance company will follow up with you if necessary from there. But deep down, I know they'll call them. But when they call them, they are okay. They don't know the insurance company. So, okay, medical information, health details involved in information. So yes, they'll ask about your medical information, your health, any pregnancy, They'll ask you, are you currently pregnant if you are a woman? Okay. So the following information will also be at height and weight, your personal doctors, because sometimes they might request for some lab work result from your doctor. So we ask all those. Okay. So there's an example here as well. And then we move to incomplete, erroneous information. Okay, truthful answers must be provided, or the policy can be voided. Material facts are facts that affect underwriting. Okay, now mistakes. What if there are genuine mistakes in the application? Mistakes may occur inadvertently through misunderstanding or carelessness. Okay, a material mistakes can lead to the policy being voided during its first 2 years after the issue or reinstatement. For example, okay, so why do they say 2 years here? Right? They say 2 years here because of what? Who is here that was in the class last week? Or that had caught up and 2 years you could, or you've watched the video and you could remember what they are talking about, why they are making reference to 2 years. Why 2 years in particular? And that's because it's what is we call contestability period. This is an exam stuff, okay, guys? Okay, because after 2 years, the insurance company cannot come and say, oh, you say this, but it's not this. No, because that window have closed. So, but within the first 2 years, if insurance company noticed there was a mistake, then they can correct it or void that policy totally. Okay, and we have an example there. All right. If 2 years pass without discovering the mistake, then the policy stands as being incontestable unless fraud has been committed. Okay, so again, read this example. We move on to fraudulent misrepresentation. All right, now fraud occurs when false information is provided to intentionally misrepresent the life insured in order to receive a policy or receive a policy with a higher death benefit or lower premium. When fraud is discovered, the policy is void, even if 2 years contestability window has passed. Smoking is one habit that applicants persistently lie about. If discovered, the life insurance company may void the policy and refund premiums paid, adjust premium or death benefit to reflect what is accurately given, for given the smoking habit. So we have also an example here for that. Okay, so we move on to incomplete information. Okay, so this is not wrong information, but now incomplete information. So what happens? A policy application must be complete. If it is not, the underwriter will return the application. Policy issue will be delayed. So typically what happened now, what the insurance company, how they deal with us now is that, so when they notice that an application is not complete, they just send us a message through the portal. Okay, and then, oh, please update with this, and then we do that. Okay, so agents comments are encouraged to comment. Agents are encouraged to comment a life insurance from the personal knowledge of observation. Yes, so I do this all the time. If there's anything I have to say, I just commented on, let's say a client tell me, okay, we're on this medication, and then we see, there are some side conversations that if I feel is relevant, I just put it there. Let's move on to temporary insurance agreements. Okay, so a temporary insurance agreement is called TIA, provides insurance coverage while policy is being in underwriting. The agent issued TIA, there is no guarantee a TIA will be issued. Okay, so now what this temporary insurance coverage does is that, why this policy? Because the insurance company believes that the policy process application process have commenced from the moment we have collected information from client and the client have signed. Okay, so now they are what we call temporary insurance agreement questionnaire. If the client answer those questions and is all knows, then and the person sign off that withdrawal of money can be made during the underwriting process, that client is covered with temporary insurance agreement right off the bat, even before the policy is issued. Let's say client completed application paperwork today, and I submit it. And that's why when we collect application, we don't sit on it. We send it to insurance company immediately. Because if that client get knocked down tomorrow and dies, the insurance company will pay, even if the policy have not been issued yet, because of what? Temporary insurance agreement. So pay attention to this, please. Okay. The TIA requires the policy application to be complete, a minimum of 1 month premium. That's why I said here, a completion of a separate TIA application, those questionnaire I just mentioned, a negative no answers to short list of health questionnaire, in that TIA, then the life insured to be in the approved age range, roughly 15 days of age to age 70. All right? Coverage limit. Coverage of temporary insurance agreement is typically limited to a lesser of a fixed dollar amount, the policy fixed amount. Okay? Suicide exclusion from coverage. Coverage of TIA, yeah. Suicide exclusion. Let's see that. Coverage duration. Okay. Did I say anything about suicide exclusion? No. Okay. So why is it here? Coverage limit, suicide exclusion. Coverage duration. Sorry, guys, I want to understand. We are talking about coverage limits, yes, and they talk about coverage of the temporary insurance is typically limited to the lesser of face amount, face dollar amount. That's they give the fixed dollar amount. It could be specific amount or the policy face amount. The ones what I typically see for the most part is policy face amount. That is whatever amount that person apply for, that is the coverage amount for the TIA. Now, suicide is excluded. Okay, suicide is excluded from the coverage. Okay, now it makes sense to me. Now it makes sense to me. Okay, so you know why they say suicide is excluded from the temporary insurance company? The reason is because, okay, if you know that, okay, you have temporary insurance coverage and you go and kill yourself before your policy is issued, that will not pay. Okay, I was trying to make sense of why is suicide there? Why is suicide there? Okay, and I'm glad I was able to explain that to you guys. Awesome. So we'll move on to coverage duration. So the coverage begins as soon as the application is completed or when medical proof is provided. The temporary insurance agreement remains in force until the earliest of number one, the date it expires, usually 60 to 90 days. Yeah, because I have clients whose policies have been in underwriting for a long time. So they'll just write me and tell me that because of the length of time they are taking to underwrite this client, that unfortunately the temporary insurance agreement have expired. And at that point, we cannot do anything. The date the actual policy takes effect, the moment the actual policy takes effect, the TIA is done its job. The date notification is received by the applicant that their application has been denied by the insurance company. Very simple. The day the underwriter decides the TIA must be revoked and informs the applicant in writing. All these ones, I've seen all of them. Okay, the premium that accompany the application is returned, okay, when the application is denied. Not the TIA, I mean the policy application generally. Okay. Agent's responsibility. So now, what is your responsibility when it comes to temporary insurance agreement? Number one, the agent believes the policy itself will not be issued, must not issue. So, okay, so as an agent, you must not issue or offer TIA if you believe that this policy is not going to be issued. I don't know why, as an agent, would believe that. Anyways, the premium is not provided with the application. You see, for me, sometimes we complete application paperwork and clients say, oh, I don't want them to take money. I want them to take money on so date, blah, blah, blah. I say, okay, based on what you've told me, you are not longer eligible for temporary insurance agreement. So I don't even bother completing it. Or the agent's observation leads to any doubt about the insurability of the life insurance. You see. So yeah, for basically the reason why I don't offer TIA for the most part is when clients tell me I don't want them to take money immediately. And then I explain to them, I say, okay, by this singular decision of yours, you will not be having temporary insurance agreement. And I explain to them what it means. And for them, Most of the time they are fine with it. Okay. 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 What have I done now? I've lost where I was. Persistent cough. So how did we get to underwriter who is processing? Okay, now the underwriter. So yes, I think this is where I was. The agent's observation leads to any doubt. Okay, now we'll move on to the underwriter who is processing the application may also revoke the temporary insurance agreement by advising the applicant in writing and returning the premium. Example is here. We should read it. Okay, underwriting by the insurance company. So you see the application on our side, as per what we do. Also, we've talked about that one. So now we're looking at underwriting by the insurance company. Once the insurance company receives a completed application, its underwriter begins the task of evaluating the risks posed by the life insured. There are underwriting guidelines. Okay, and the guidelines that the insurance company use for the underwriting, we have access to it too, you see, as a broker. You see, when you start doing this, you're going to appreciate the prestigious role that we play and everything we do and how it aligns with the insurance company. Okay, now, underwriting guidelines. Each insurance company has its own underwriting guidelines. The guidelines establish the standards and they set out key elements that must be considered. When the standards are not met, usually more information is needed to assess the risk. Then we have example here. Okay, now the insurance company may have separate guidelines for medical, non-medical, and financial underwriting. Agents may find it helpful to review the guidelines so they can help clients set realistic expectations about the outcome of their applications. Again, you see, I don't go through example because I want you to go back and read those examples yourself. Okay? Because if I start going through every example, we're not going to live here today. All right? Okay, so we move on to attending physician statement, APS. Okay, we're going to be seeing APS, Medical Information Bureau, and the likes. So pay attention to this. They're going to be asking you APS, and then we'll see the rest later. Okay, an APS is provided by the personal physician of the life insured upon request by an underwriter. The insurance company contacts the physician and pays any fee for the statement. The physician returns the completed APS to the insurance company. Okay? The APS is a more detailed record of medical history, current health, and future health expectations. It usually addresses a specific medical problem or conditions. Medical exam. The underwriter may request a medical exam, especially if a large amount of insurance coverage is being applied for, or if the life insured is older. Okay, an example may include a range of physical tests depending on the indicator. Okay, so this is an exam. So this one, we book it. I think I mentioned it earlier. We book it, then the insurance company will send their nurses to the client's house to just do the exams, either it's blood work or whatever. Okay, but APS is requested directly to the physician's office, to your doctor's office. Okay, and then your doctor's office will send those attending physicians statement to the insurance company. Here we are now talking about Medical Information Bureau. Okay. So the Medical Information Bureau exchanges medical information about applicants between insurance companies. So now, your medical information bureau is just like credit bureau. Okay, you know, for credit bureau, a check is run on you to see your financial worthiness, right? Same thing is the same way the medical information bureau. This is a database that stores our medical information. And this database is accessible from anywhere within Canada. Anybody can access it within Canada. So APS is only limited from your physician, but MIB is generally accessed, okay? An applicant must give permission for their information to be shared with the MIB. When someone applies for life insurance at MIB member company, they must be informed about the nature of the MIB and must also sign or release authorizes the insurance company to search for the information about their medical information bureau. Okay? Now, an underwriter reports medical and non-medical issues to the MIB, where they are coded and stored. You see that the MIB makes the information available to future underwriters when the same applicant applies for another where am I? I found MIB data can lead to underwriter requesting. Okay. Okay, applies for another policy or policies. Okay. MIB data can lead to an underwriter requesting substantiating information from a doctor or other sources. The MIB data in isolation cannot be a reason to deny a claim or apply for a higher rated premium. So we can see an example here. Okay, that's a very long example. Okay, so we move on to motor vehicle record, MVR. Okay, a motor vehicle record provides details of a life insured's driving history. Poor driving habits are directly correlated to a higher risk of death. So the underwriter will have an interest in violations, accidents, drunk driving charges, license suspensions, and so on. So these are databases that the underwriter have access to, okay? And they check it up, they look it up to see the depth of risk they're undertaking. Does this person drinks and drive? Does this person have their license suspended in recent times? What kind of driver is this person? Okay. Statistics have shown that a person's driving records directly influences their risk of death. As a result, infractions such as failing to use seatbelt or speeding may often cause a life insurance policy to be rated, resulting in much higher premium. Inspection report. Okay. An inspection report is completed by an independent contractor by a telephone interview. More commonly, a personal visit, less commonly. Okay. Now, it focuses on a non-medical issues that need more detail or investigation, such as personal finances or dangerous hobbies. Okay. Now, an inspection report usually focuses on a non-medical issues and could include questions about life insurance. For example, is smoking, tobacco, um, use of alcohol consumptions. And then the one for finance will revolve around income or estimate of net worth. Then there will also be questions around occupation, driving records, and avocation. What does this mean? Participating in extreme sports. Oh, or hazardous travel. Okay. All right. So we'll move on to requests for clarifications or more information. So unclear or incomplete information will require the underwriter to ask for more information. And this slows down underwriting, of course. Okay. Then financial underwriting. So now this, when it comes to finances, these are the stuff that they look into. Just as a medical underwriting establishes evidence of good health, financial underwriting establishes financial health. That is the ability to pay premium and the need for the coverage. All right. Life insurance companies provide a maximum amount of coverage based on how the coverage will be used if the life insured dies. If the use for income replacement coverage may be set at a multiple of earned income, this multiple declines with multiple or typical, sorry, this multiple typically declines with age. Yeah. Okay, so this is talking about income replacement, right? Dependability period, right? As a person grow or age, the amount of dependence or the amount of things that person will have to do reduces. You know, like I showed you guys in Hllqp yesterday, right? So as you grow older, you see that curve will start becoming a downward trajectory mode. Okay, and then if used for estate planning, coverage may be tied to net worth. Okay. Now, if the policy is for a university student, coverage may be tied to the intended occupation. Okay. Moving on to people who are not Canadian citizens. Can a non-Canadian citizen get life policy? That we're going to look at. Well, different underwriting criteria may apply to those who are not Canadian citizens. For example, permanent resident. A permanent resident has been granted permission to live and work in Canada without any time limit or their stay. So permanent residents are generally treated for underwriting like Canadian citizens, except they may have to provide a copy of their permanent resident card. Okay. A permanent resident who has been in Canada for less than 1 year may have to provide extra medical proof of insurability. Okay. A permanent resident who frequently visit their home country may face a rating for premiums or exclusions of coverage when at home. So what this is talking about is that a permanent resident is assessed same as a Canadian citizen. Okay. However, if a permanent resident is less than 1 year in Canada, but I've done policies for people who are less than 1 year in Canada, and basically there's not much this thing. However, if this individual is traveling alone, not only permanent resident, even if as a citizen, you know, you are always traveling to your back home country, then you might be slammed with exclusions that will exclude, you know, for example, you're from Nigeria and you are frequently in Nigeria. So they may exclude Nigeria from your policy. That if anything happens to you while you're in Nigeria, it will not be covered. That's what exclusions means. However, if your policy is Egypt, if you like go every day to Nigeria, it doesn't really matter at that point. Awaiting permanent residency. Well, those who have not been granted permanent residency may not be eligible for coverage. If coverage is available, its maximum may be linked to occupation. For example, you can see here. Okay, so now again, but anyone that is in Canada that has work permit can obtain life insurance. I can tell you guys that for a fact. Okay? International students. International students are those from other countries who study in Canada. They do not usually qualify for coverage. Those who travel frequently may be deemed higher risk. I hope I've not jumped anything. Yes, you see, this thing kept jumping on me. Frequent travelers. Those who travel frequently may be deemed a higher risk depending on the frequency of travel, where they go to, and how long they stay. Travel to certain countries may be excluded from the coverage. For example, persons who frequently travel to Afghanistan may find that their death benefit will not be paid if they die in Afghanistan. Evocations. An evocation is a hobby or activity voluntarily undertaken outside work for personal enjoyment. Common high-risk evocation includes parasailing, scuba diving, backcountry snowboarding, and skiing. Okay, participation in high-risk evocation will require an underwriter to assess how frequently the life insured participates, the location and timing of their participation, expertise in the evocation and past accidents or certification violations. So underwriter will review all this. Okay, risk classes and their impact on premium. So now we're going to be looking at the different risk classes and their impact on premium. Okay, let's click on 9.5. All right. Now recall that when evaluation, the risk, no, recall that when evaluating the risk of the life insured, the underwriter starts with a baseline. For example, 100, and then adds to or subtract from this amount after evaluating each risk factor. And based on how the life insured compares to the standard person of the same age, when this evaluation is complete, then the underwriter can assign the life insured to a risk class. Each insurance company will have their own class system and number of classes, but general categories are discussed below. So these are general categories of risk classes. We have standard, we have preferred, and then we have what? Rated. Okay. What constitutes the standard? Every insurance company will have a standard or normal risk category, which represent the average person. Okay, the life insured in this risk class is offered a standard premium. So this is a normal person, everything is good, that is standard. Then we move on to preferred. Most people fall under the standard category. Okay, now we move on to preferred category. So insurance companies usually have one or more preferred categories for people who present an exceptionally low risk. The life insured in these risk classes is offered a lower than standard preferred rate. So this one now, they are so exceptional that they even give them a lower rate than standard. Okay, now the next one is rated. A rated risk is above average risk, but still insurable. Okay, so still insurable. So the life insured in this risk class is offered a higher than standard premium. So what this is saying is that if standard pays $100 and then a preferred probably pay like $95, rated maybe will be paying like 120, right? A rated risk is a risk but still insurable, right? Pays higher this thing. What leads to what I've noticed makes people's premium to be rated is maybe when they are smokers and stuff like that. Then we move on to exclusions. You see, excluded risk is one particular factor that must be excluded from the coverage. The life insured in this risk class is offered a premium for their risk class that is standard, preferred, or rated, with an exclusion for death arising from the identified factor or event. You know, those factors we talked about earlier, right? So there may be, traveling to a certain countries and stuff like that. As we can see in this example, Nick is a standard risk, except he frequent scuba dives. Sorry, he frequently scuba dives. Nick's policy specifies that the death benefit will not be paid if he dies scuba diving or as a result of scuba diving. Okay, so we also see another example here for Michael. Now, upgrading risk class. Once a policy is issued, the risk class cannot be changed to a higher rating. For example, a preferred class cannot become standard. Okay. However, it is possible to improve the life insured risk class if the reason for the rating no longer exists. Yeah, that can be done. Okay. For example, just received job from being a fireman to being a computer programmer. He could request his policy risk to be assessed if the risk factor of his new job is lower and his premium may go down. Okay? The reason that a life insurance company would consider a request for reassessment of premium cost is competition within the industry. If the rating is not removed, the policyholder may be tempted to cancel the policy and apply for a new policy with a lower or no rating at a competing company. For example, when Bill first applied for life insurance, he was a commercial fisherman, which is one of the most dangerous occupations in terms of risk. In terms of risk, so where is that? In terms of risk, my school, I don't see. Okay, in terms of risk of death, why he was able to obtain insurance, the policy was rated and came with a hefty premium. Once his daughter was born, Bill left the fishing industry and he now works as a janitor for the local school board. Bill should ask his insurance company if the hazardous occupation rating can be removed from his policy with a corresponding reduction in premium. Okay, so we'll move on to decline. All right, so we'll move on to decline. When a risk is too great, the application is declined. All right, a permanent decline will never be reconsidered. A temporary decline will be redefined as a period of time that must pass before application is made again. So move on to client factors that may affect premium. What are the factors that may affect premium? One of the components that affects life insurance premium is the net cost of pure insurance, NCPI. You guys remember NCPI? Well, that really, really do affect premiums, okay? Which in turn is based upon the risk that the life insured will die during the period of coverage. Okay, now the risk is evaluated during the underwriting process that was just discussed. There are many risk factors that are common to all people, and this section examines those risk factors and their impact on the policy's premium. Number one is age, okay? The age costs pure, the net cost of pure insurance is one of the factors used in determining cost of insurance premium. And this cost is based on the risk that the life insured dies during the period of coverage. Okay, risk of death increases with age. Therefore, premiums increase with age. Note that this relationship is not linear. Okay, the risk of death increases at a greater rate as a person's ages, particularly after the age of 60 to 65, as we can see in this diagram. Okay. Based on rates provided by Canada Life for the first 10-year term of a 250,000 10-year renewable term life insurance policy for a male with standard health profile. So we have what we call, so when it comes to age, we have attained age. You see, this concept was introduced in chapter 2. We've already dissected attained age already. So if you watch the video, you're going to learn more about this attained age thing, okay? And then remember from chapter 2 that depending on the insurance company, the attained age of the life insured may be the age of the life insured on their last, nearest, or next birthday. Okay, so another factor that determine premium is what? Gender. You see, women generally live longer than men. Therefore, men have a higher risk of death. Premium for male life insurance are generally higher. Okay, all other factors being equal than for females. Okay, as you can see in this graph. Okay, based on rates provided by Canada Life, a 10-year renewable term life insurance policy for a male and female with a standard health profile. So we can see that here. Okay. Now, health status or risk. So another factor is health status. So age, gender, health status also contribute to the amount of premium that the insurance company charges on a particular coverage. Okay. In section 9.5 that we just, saw above, it states that the higher risk equals higher premium. Each time insurance company will have its own system for classifying risk, and most companies will have between 3 and 5 risk categories. You can see that here. See? There's worst smoker, good smoker, and standard non-smoker. Okay, so this one is better than standard non, and then good smoker and worst smoker. Okay, based on the rates provided by Canada Life, you can see. Okay, hazardous occupation. So another factors. Remember, we looked at age, gender, and then the third one is what again? Let me see here. That determine premium is health or risk status. And now the fourth one is hazardous occupation. You see, a more dangerous jobs have a higher risk of death and correspondingly higher premiums than jobs with a lower degree of physical risk. Okay. Then we also have hazardous lifestyle. Okay. Whenever and however risk is introduced, it is accommodated by charging a higher premium, unless the risk is so extreme that it leads to the policies being declined. Okay, now the next one is what? Company factors that may affect premiums. What are the company? This one now is factors that affect premiums on individual, that is from the insured perspectives. Now, what are the company factors that may affect premiums? Recall that once a policy is issued, and the premium is set, premiums cannot be increased. Therefore, if a life insurance company experiences higher costs than anticipated, a lower revenue, then it can only charge higher premium or new policies that it issues. Okay, so this one will not have anything to do with existing policies. Okay, if insurance company is experiencing problems, the only area they can charge is more premium is on the new policies that they issue. Okay, then we look at mortality cost. If life insurance company underwriters do a poor job of risk assessment, then the company may pay more in death benefit than anticipated. Okay, or pay sooner than anticipated. Okay, the amount actually paid out in benefits are the mortality cost for the company, right? Because every time somebody have life insurance and they passes away, the insurance company is paying. Okay, so this can drive premium prices for the company, and the insurer may lose its competitive edge in premium pricing. All right. So what the underwriter does is very critical, because if they does poor job and categorize people in the different risk category, and they end up having to have more people die than anticipated, then it will be a big problem for the insurance company. So if an insurance company has higher mortality cost than it's expected, then it may raise premium on the new policies to compensate that, not on existing policy, on the new policies. So we move on to administration cost and expenses. Admin costs and expenses. Admin costs and expenses. What are the administrative costs? Guys, don't worry, we are almost rounding up chapter 9. Chapter 9 is a big chapter, because I'm looking at it. It's such a, yeah, chapter 9 is indeed big, okay? But we are almost wrapping it up. Okay, so the administrative costs and an insurance company is a business that, like all businesses, has expenses, and this includes expenses such as marketing, underwriting, issuing and administering policy documents, and investigating and processing claims. An insurance company must earn enough to pay its costs through its investment of premiums and premium charges. Okay, a company with higher cost will charge higher premium. That's very true, right? Investment returns. Okay, now insurance company, earn returns on investment, because when we put money into an investment, insurance companies just put those money into a vault and leave it there. No, right? They invest those money too. So as described above, investment returns are key for the payment of expenses. Low investment returns, whether current or expected, can mean higher premium. Okay, then we move on to reinsurance. As noted previously, a maximum limit applied to the amount of coverage available in a life insurance policy. Such maximum are called the insurance company's retention limit. A company insures individuals to its retention limits. If coverage is more than that limit, a reinsurance company assumes the balance of the coverage. Okay, this is a very straightforward, and I'll read this example for you guys to see. A plus insurance has a retention limit of 25 million. If a policyholder wants 30 million in coverage, Z plus reinsurance provide the extra 5 million in coverage. Okay, so every insurance company have retention limits, and any insurance demand that is above that retention limit, that insurance company can cover up to their own retention limit and seek the difference from a insurance company. Okay, the policyholder pays the premium to the insurance company, and the insurance company pays the premium to the reinsurance company. All right, to this reinsurer. Okay, now on death, the insurance company pays the full death benefit, and the reinsurer pays its shares to the insurance company. All right, as per the preceding example, the life insured will get 30 million if the life insured with 30 million in coverage dies. A plus insurance pays the beneficiary 30 million, and AZ reinsurance pays 5 million to AZ insurance. Okay, issuing policy. The underwriting process does not stop with the issuing of the policy. It continues right until delivery and acceptance of the policy. Of course, the policy will have to be delivered, and the policyholder have to accept for that insurance process to be completed. So what happens at delivery of the policy? Well, delivery is another step in the underwriting of the policy process. Delivery should be made by the agents in person. Again, like I said at the beginning, that was before COVID. So now we don't go in person. The insurance company mail it directly to the policyholder, and then we do the delivery over the phone or in person if the person is within the same locations as us. Okay. Um, Changes could be made. Okay, so delivery should be made by the agent in person to assess any last minute changes in the risk posed by the life insured. Changes could be financial due to changes in their occupation or other ages, or it could be medical. Again, like I said earlier, let's say the person went for medical and something was found and stuff like that. The changes could also be what? Lifestyle due to a new interest or activity or discontinuation of an avocation declaration on the application. Okay, the agent should review with the policyholder everything that is in the delivery document. Now, there's what we call a grace period. There is a 30-day grace period. Okay, following the grace period, the 30-day following premium due date, in which the premium can be paid before the policy lapses. That should be reviewed with the policyholder. Okay, we always review that. There's always 30 days grace period. If the person failed to pay or the policy premium doesn't go through, there's a grace period that the clients have to make that payment. And then there's what we call incontestability clause. The 2-year following policy issue, okay, in which the policy can be voided by the insurance company if material misrepresentation occur. And there's also suicide exclusion. Okay, so there are 3 of them: grace period, contestability, and suicide exclusion. Okay, the 2-year following policy issue, in which the death benefit will not be paid if death occurs by suicide. The policy should only be delivered after satisfying these conditions. Receiving confirmation in writing that there has been no material changes in the circumstances of the applicants and receiving outstanding premium. Okay, we don't receive premium anymore. All this is what we call settlement requirement documents. So these are the final stage of our work. Okay, you do this settlement requirement document, send it to insurance company, that policy is settled, then you get paid. Okay, if the agent suspects or confirm a change, all policy documents should be returned to the insurance company for further consideration.
I fell down. Yeah. No.
Please, can you mute yourself, Jama?
How comes?
That's wrong, buddy. How come? No, I was climbing something. It was too fast, so I slipped.
Guys, give me 1 second. Let me mute.
It's okay.
Okay, she has muted herself. Okay. All right. So again, you may be thinking, okay, Joy, how do we stop the delivering of the document considering that it has been mailed out to the client? Well, the way you stop that delivery, even though it's been mailed out to the client, there's what we call settlement requirement document that will be sent to you. And that's where you go through all these things with the client. So in that settlement requirement document, once you note your observations and all these things, send it to insurance company. The insurance company will send a letter to the client with any update they might have or their decision either to keep the policy or not. Okay. Now we move on to acceptance. Okay. The policy holder must accept the policy by signing and dating an acknowledgement provided by the insurance company. See that settlement requirement document that we go over, that's the final document we review with the client. Client must sign. So that is a final testament that yes, everything is okay. Client say, okay, as I said, that's a testament that clients have accepted the policy. After acceptance, client review period begins. During this period, the client may exercise their right of rescission. Okay, there is what we call rescission is a legal right to be free from the contract because insurance policy is a contract. For insurance, the policyholder must review the premium of 10 days to exercise their right. Therefore, the client has 10 days right of rescission period. During this period, the client should review the policy and its details. Note that the right of rescission for the insurance company is 2 years, not 10 days. As for the client have 10 days for right of rescission. Okay. As their 2-year contestability period. Okay, so let's move on to group insurance. All right, group insurance. Okay, underwriting of a group policy is done on a group as a whole. Okay, it's not on individual by individual basis, it's done on the group as a whole. All right, and the underwriter examine the characteristics of the group, such as the mix of the group, the age, the gender of the group, and then prepares one group against the company's experience with a similar group to assess the risk in order to determine the premium for the group. So as we're talking about the group now, when you review the previous recording, then you will know what group insurance is all about, okay? Then there is basic group life insurance, okay? If there are no membership classes, such as difference between benefit for different classes of employees, then one cost per 1,000 coverage applies to every group member as the premium. And when membership access classes exist, each class at its own premium rate. So premiums are usually calculated annually. We move on to additional coverage. Additional coverage, okay? As discussed in group insurance, additional life insurance coverage may be offered to a group member, for example, as unit or as term insurance. Individuals who apply for additional coverage are usually required to provide proof of insurability and underwriting on an individual basis, okay? Creditor life insurance. Yeah. Then move on to creditor life insurance. A creditor life insurance is a type of group insurance. Underwriting for creditors life insurance is superficial based on a questionnaire that requires yes or no responses. You see, I explained this creditor life insurance in the previous lesson, so I'm not going to go into this, okay, because I just want us to wrap this chapter and see if we can take another one more chapter for this morning. Okay. All right. So it's a yes or no responses. Now, when creditor insurance is offered through a financial institution, not an insurance company, the applicant must complete the application without assistance from any employee of the financial institution, as those employees are not insurance agents. You see, that's why when people go to the bank and they're taking mortgage insurance, creditor insurance is basically mortgage insurance. Okay. Now, coverage is usually limited to established maximum unless medical underwriting is performed. Okay. Now, premiums are set at a fixed monthly rate based on the loan outstanding and the age group of the life insured. Okay. Post-claim underwriting. You see, that is the part that is very dangerous to creditor insurance, because they don't do any underwriting until claim time comes. And that post-claim underwriting occurs after a life insured has died. It assesses whether a life insured qualifies for coverage. What nonsense. Pardon my language, please. You see, it doesn't make sense, right? Somebody have been paying premium, you didn't do underwriting when this, and that's what we tell people. And that's why you guys, we need to go out there to educate people, because people are running to bank and collecting mortgage insurance. They don't even know what they are setting themselves up into. You see, the underwriting may determine that a death benefit should not be paid. There is no recourse for survival if it is not paid. Nothing the survivors could do. You see that? And that, my friends, bring us to the end of chapter 9. Trust me, chapter 9 is a really huge chapter. But at the same time, for me, I went through it, with so much joy and excitement, with so much learning in it, right? If you are getting bored, please don't be, because it's a whole learning experience. All right. I think we can take 5 minutes bathroom coffee break, and we come back. And I want us to, in the next 1 hour, we finish at 8 to see if we can quickly plow through chapter 10. Okay, guys? So let's take a 5 minutes bathroom break, and I will see you. Welcome back, and we move right into chapter 10. So chapter 10, we'll be talking about assessing the client situations. Okay, assessing the client situations. And how do we assess that? Again, this chapter 10 is directly tied to chapter 9. So we're going to see, right? Assessing the client situation is case study. The concept in this chapter, as well as chapter 11, will be illustrated during a case study focusing on Derek and Becky's family, who are introduced below. Okay, Derek and Becky's family case study. I don't know. Is there any IT guru here? This thing, every time I move, it jumps in such a way that my eyes start looking for where I was. Okay, Derek and Becky are 47 and 38. So it therefore means Derek is 47, Becky is 38. Now I'm clicking to go to the next page. Okay, 7-year-old respectively, and have been married for 2 years. Derek and his previous wife, Susan, who is age 44, divorced 4 years ago, and they share joint custody of a son, Jordan. Okay, so they're trying to give us the understanding of family dynamics, because you see, in this part of the world, we see this a lot. You see, not in our community, but we want to do this business such that we understand the environment that we are and the family dynamics that could exist. And I can tell you for a fact that coming from somebody who owns a daycare, these dynamics exist a lot in this environment that we are operating. So understanding it will make you know how you perform your role as an advisor effectively, efficiently, and ethically. Okay? So now they have a joint custody of a son, Jordan, who is 8 years old. Prior to marrying Derek, Becky was a single mother to Anya, age 4. You see that? Are you guys following? So Becky has her own daughter who is 4 years old. Derek has joint custody with Susan of 8-year-old. And they divorced 4 years ago, right? Derek formally adopted Anya's daughter, adopted Anya. Okay, Anya is Becky's daughter. Okay, Derek adopted Anya when she got married. Derek and Becky have just had a child together whose name is Robbie. Robbie is 2 months old. Are you following this story, this case study, right? Derek and Becky are concerned about securing the financial future in the event that Derek dies, and they have approached a licensed life insurance agent to help them assess their insurance needs. Isn't that interesting? Right? And that's why, I've always been talking about needs analysis. We ask questions. You see, there was a slide in one of the things I presented to you guys about what I did, what we do. In that slide yesterday, how we sit down with family, asking the right questions. We uncomplicate. These things are not complicated. You ask the right questions, right? Now, in assessing family dynamics, because many people use life insurance to provide financial support for their families upon their death. Agents need to understand their clients' family dynamics before being able to advise how to best provide that support. See that? Can somebody help me post it in our Telegram group again? You see, class is going on. Please join. Because I want everybody to, if you're in this class, you can learn a lot very quickly. Now, we look at the current spouse. Many people use this life insurance to provide financial support for their families in the event of their unexpected death. There is an expectation that when people are married, either as a legal or common law spouses, the income earners in the family will arrange their affairs so that their spouse and children will be supported financially if they die. The amount of support will depend on the nature of the relationship and surviving beneficiary's own financial capacity. For example, if there is a primary income earner that is a single income household, that individual will become the proposed life insured in a life insurance policy, and the spouse will be the beneficiary. In dual income household, so I hope you guys understood what they mean when it's a single income. It's very straightforward. So we're going to start spending time on that again, right? In dual income household, the surviving spouse may earn enough to be fully self-sufficient if one spouse dies. So dependent versus self-sufficient. A sole income earner for the family will usually need to replace his or her entire income for the surviving spouse's use, or to help cover childcare expenses if the spouse were to return to work, because the main income provider is no longer there, right? If the life insured and spouse both earn an income, each spouse's earning Earning power will be taken into consideration when determining the total amount of financial support that will be needed. Okay, now we are going back to our case study now. Okay, Derek is employed full-time as the Vice President of Industrial Design for a manufacturing company with a take-home pay that is income after tax and deductions of 8,400 per month. Becky currently stays home caring for Jordan, Anya, and Robbie, but they intend to return to work as a human resource manager once Robbie is in school full-time, about 6 years from now. She anticipates that her take-home pays will be around 4,500 per month. However, Derek feels that if he dies, he would prefer that Becky will not have to return to work until Robbie is 18 years old. If at all possible, if Derek were to die today, the family will obviously suffer from the loss of his income. And even if Becky could return to work immediately upon his death, her income will be insufficient to maintain the family's current standard of living. You see that, right? That kind of, see, we're following the case study, right? So let's keep going. And that is what we call dependability period. Let me go back to the topic we just, dependent versus self-sufficient. Okay, dependent situation versus self-sufficient. Okay, now support obligation to ex-spouses. And ex-spouses may require financial support. The obligation for financial support may end if the ex-spouse remarries. Now, wow. Now, court-ordered insurance, okay? Again, a court may order life insurance. When a court demands financial support for an ex-spouse, the court order often will specify that sufficient life insurance, naming the ex-spouse as beneficiary, be obtained by the supporting spouse to satisfy the support obligation. Wow. Are you guys hearing that? Without life insurance, the ex-spouse could make a claim against the estate of the deceased spouse to seek financial restitution. The life insurance death benefit must be calculated based on the monthly support obligation multiplied by the period of time for which support has been ordered. For example, the monthly support obligation is $1,000 and it is ordered to last for 16 years. The policy death benefit must be a minimum of what? $192,000. That is $1,000 multiplied by 12 by 16. As from our case study, taking this into our case study, Derek and Susan used a mediator to develop their spousal support agreement, which specifies that Derek must pay spousal support of $500 per month until Susan reaches age 65 or remarries, which occurs first. Where am I now? Okay, whichever occurs first. While their support agreement was not court-ordered, Derek told his life agent that he wants to ensure that the $500 in spousal support is paid monthly to Susan, even if he dies. So again, when you have minor children, in the case of minor children, minor children should be provided for at least until age 18, or if the child is enrolled in full-time in the post-secondary institution and is still dependent, then the support obligation will be required to continue until approximately age 22 or 23, in bracket, the completion of the first post-secondary degree. This is so true. I know somebody whose child is in university now, and he's still paying the support. Initially, I thought it's still age 18.
What?
See that? The financial need may
You put that
encompass. Sorry? Can you mute yourself, please?
I know it was there. Okay.
Okay, I need to. Okay, cool. All right, let me be sure I did not. Okay, still recording. So the financial need may encompasses both living expenses for the children and the cost of post-secondary education. So like in our case study now, we go back again to Derek. You see, we're going to be using Derek for the most part of in this chapter. All right. Derek wants to ensure that Becky has the financial resources she will need to raise their children if he dies prematurely. In addition to their living expenses, he will also like to ensure that all three children will have enough money to pay for post-secondary education. Okay. So again, like I said, when we do field training, you're going to see how these needs analysis are done, the questions that we ask. And that's why at the end of this meeting, I will share my calendar in the Telegram group. Go there and book for yourself first. Okay. So I will go through it with yourself, and then you just see how it was and see how we do it with clients. Okay. Now, in the next lesson, we look at current care arrangement. What is the current care arrangement for children that is in place, right? A stay-at-home spouse and a caregiver to children have economic value. Consider the cost of paying for a full-time childcare. The death of a stay-at-home parent can also have a huge financial impact on the family. You see, what this is telling us is that, you see, even though, let's say, a man is a medical doctor and his wife stays at home to take care of the children, right? Now, that man is bringing value, but the woman that is staying at home is also bringing value as well. So we don't just look at the man, okay, since it's this man that is bringing the money, he is the only one that needs to be covered. What if it's not the man that dies? What if it's the woman that take care of the children that happens to die? So what now happens to the children? How would the man be able to go to work and take care of the children at the same time? It's going to be difficult. So this is what current care arrangement is talking about. Then in the case of our case study, Becky is not currently earning an income, but her role as the stay-at-home mom, as a stay-at-home parent, is vital to the family. If she dies, Derek will have to pay for someone else to take care of Jordan, Anya, and Robbie so that he could continue to work. In addition, the family will not benefit from the income Becky hopes to earn when she returns to work in 6 years. Okay, so the next one is child support to ex-spouse. You see, when there is a child support arrangement to an ex-spouse, the fact that somebody dies doesn't end that child support. So that spouse can still come after the estate of the deceased ex, to seek that support from the estate of the deceased. So there's a legal requirement to provide financial support for children from prior relationships who may be in the full custody or partial custody of the ex-spouse or ex-partner. So, and for that security to be there, a court may order a life insurance, you see, because a court may order a partner to pay child support, and as part of the court-ordered divorce or separation agreement, require the supporting parent to obtain life insurance so that in the event of death of the supporting parent, the support obligations will continue to be satisfied until the child reaches adulthood, if no longer is reaches adulthood, that is in bracket, where support is no longer legally considered a dependent. Okay, so it means that even courts can order a life insurance. So if court can see the need for life insurance to an obligation, right? Then why can't we as people sit down to evaluate our own need for these things and do it for us? And that's where you and I come in, to go out there and educate people and unpack this information. Say, hey, have you looked into this lately? Have you thought about this? Have you thought about this? Have you thought about that? And then we come in to help them. Okay? If the court ordered for a child support, if the court order for child support is silent on the issue of how support is to be paid in the event of the death of the parent who is paying the support, the surviving parent may have a claim for the support against the estate of the deceased on behalf of the child or children. I've talked about this already. I mentioned this. Now we go into our case study again. Derek agreed to pay child support to Susan for Jordan in the amount of 1,000 per month until Jordan is 19 years old. While it was not specifically addressed in their agreement, Derek wants to ensure that Jordan continues to benefit from his support even if he dies. Oh, has this thing jumped on me again? Even if he dies. Okay, so that is 271. Okay, even if he dies, support against the estate of the deceased on behalf, is this not making sense? Did I jump anything? Continues to benefit from this support even if he dies. Oh dear God. Okay, support against the estates. No. This is like going back.
Go up one notch. I think we were there earlier.
Were there earlier? This one?
No, go up a little more. Next one.
This one?
No.
Because I don't think that sentence would have, concluded. So this is 272. Other dependent. Oh God.
No.
Okay, the way this thing scroll. 272, 271. So child support of ex-spouse. Other dependent. Okay, so I guess I'll have to continue because I'm not sure why this is jumping around like this. Anyways, so when we talk about other dependent, depending on the life insured situation, there may be other family members who will suffer financially if the life insured were to die. Especially for a lot of us that are first generation immigrants, myself inclusive. For many of us, we are responsible for our parents. We're responsible for our siblings, even the ones older than us, right? So, and then we are responsible for So many people in school that we have given scholarship. What do you think will happen? And then we also have estates back home, as in estate, properties, investments, right? Now, what will happen to us if we, to all these people, if we are no more? Those are the ones that constitute other dependents, right? Then move on to disabled family member. A family member who is disabled may require significant financial support and can, during his or her life, with such financial burden. Let me take that again. A family member who is disabled may require significant financial support and care during his or her life. With such financial burden, the policyholder must plan for the estate to provide the necessary support. Again, we go back to our case study. Scrolling this thing now, I'm like, oh my God, don't jump on me. Derek and Becky are fortunate that all their children appears to be healthy, and they expect the children to eventually become financially self-sufficient. Derek's older brother, Peter, and his wife, Janine, are not as fortunate. Their 8-year-old son, Chase, has a severe developmental disability, and he will never be able to live independently. However, Chase has a normal life expectancy, so Peter and Janine need to consider how to provide for him over a time frame that could extend 50 years or even more. You see that? See that? Especially for parents with special needs children, it can be very challenging. See, and that makes it critical and important to plan. You see, now aging parents. Okay, I didn't even say this. I mentioned that already. You see, financial support for parents may be another need to be factored into the life insurance coverage calculation. Depending on the parent's financial situation, this may be financial or physical or both. Okay. It may be that you might need to be taking time out to go take care of your aged parents and stuff like that. While you are there and you are not able to be at work, then you might be missing some income from work too, right? So you might want to consider, a benefit that could replace your income sometimes. So those are the questions we look into, factors that we consider. Then assess the employment situation. No, the agent must determine whether income is earned as an employee, a business owner, or from retirement savings, as loss of income is one of the biggest financial risks associated with that. Okay. Associated with the okay. So as an employee, the following factors should be taken into consideration for an employee and their insurance needs. Number one, current income. Okay. Income that is earned on a regular basis. That is your take-home pay. Okay. The amount you receive after all deductions. See, that is earned income. Okay. Needs to be taken into consideration. All right. If income is lost due to death of the primary income earner, insurance can restore the lost depending on the power. Sorry. If income is lost due to the death of the primary income earner, insurance can restore the lost spending power for the survival. The amount needed for this spouse is calculated as net income multiplied by the number of years until the planned retirement age. Okay, we also refer to this as dependability period. So if the net income is 100,000 and you want to provide for that for 10 years or until a specific age, you just multiply that by the number of years. This is a straight line calculation. So if income earned by an employed spouse may reduce the total sum income. So if the income by the deceased spouse is 100,000 and the survivor one earned 50,000 or so they can consider reducing the coverage, right? Because that will also reduce how much they pay in premium. Now, future income potentials. What is likely to happen with a job in the future? Is income likely to increase due to increased wages, better job prospects, and to keep pace with inflation? Or if the desire is for the family to be able to maintain the same standard of living after the death of the life insured, then the insurance needs analysis needs to factor in expected future income and inflation. Okay? One possible solution to this need will be a universal life policy, which through the investment account can provide an opportunity for investment growth and thus an increasing death benefits. So when we go back again to our case study, Derek, who is a vice president with take-home pay after all taxes of 8,400 per month, he expects to be promoted to a chief operating officer within the next 2 years, which will increase his take-home pay to 9,500 per month, with a potential for larger bonuses as well. And this might suggest that he will want the flexibility to increase his insurance coverage in the future to factor in what he's expecting to be earning at the time. And there's a way we can structure that in life insurance coverage. So the next thing we look into is job stability. Okay, job stability. Does the life insured have a record of job and income stability? Job stability of both spouses is important to ensure future premiums can be paid, right? We don't want people taking policy and they are out of job and they are struggling to pay their premium. Okay, if income could be variable, then a policy should be offered that allows the life insured to temporarily reduce premium without reducing coverage. Okay, in the case of our case study, why Becky plans to return to work once Robbie is in school full-time, she is worried that her time away from the workforce and her outdated technology skill may make finding a new job difficult. So she may even have to spend time updating her training before she is employable. And this makes the replacement of Derek's employment income even more important if he dies. Okay, so we move on to group benefits. So now if we are looking at family dynamics, all these things that we have looked into when it comes to individuals' family dynamics. So in a group insurance settings, how does that play out, right? So that is where we are going now. That is 2:10 to 4. Existing buy and sell. Okay, so group benefits. Oh my God, this time is flying. How am I going to race through this? Okay, the family of an income earner with a group benefit may lose those benefits when their income earner dies. Okay, replacing the benefit provided by group benefit coverage will comprise one need that should be included in the life insurance needs analysis. Okay, so when it comes to calculating how much coverage is appropriate in a personal policy, a life insured who is a member of the group life plan should reduce the amount of personal coverage needed by the amount of the group benefit. That's what it is. In the group benefit, you really don't have control over it because as we learned in the previous chapter, everybody falls into the group classes, right? So it's what is assigned to your group class that you get, even though you can take additional coverage if you want. For example, Guy receives life coverage at work to a maximum value of his salary, which is $220,000. Therefore, his need per personal coverage could be calculated and reduced by 220,000. Likewise, if his group policy provides survival income benefits, as we saw in chapter 6.4, section 6.4, then this will also reduce coverage required from personal coverage as well. Okay, see government benefits section in chapter 10.4.4. So now, case study with 3 young children. Derek Becky expect to have many uh, dental and medical bills over the next 15 or 20 years. Becky already suffers from some arthritis. As a result, they wear custom ortho, okay, I can't say this, and see a physiotherapist regularly. All of those expenses are currently covered by Derek's plan, but that coverage would cease upon his death, increasing the strain on the surviving family's cash flow. Okay, so that is on group plan. Okay, so anybody that belongs to a group plan and it is the spouse that provides the group plan that passes away, then what will now happen to this family, especially if they are on any medication, if they are, it's going to be a big deal. All right. Now let's look at how about a sole proprietor, a business owner like all of you on this call now that own your business. If experienced business is the only business you do, a business operated as a sole proprietorship often ceases to exist with the death of the sole proprietor and may be subsequently sold, right? Upon the death of the sole proprietor, net income is reported on the final tax return and with the potential for tax owing on income earned from the sale of any business assets. Now we go back to our case study again, all right? While neither Derek nor Becky is self-employed, Derek has 3 siblings, Peter, Mark, and Kimberly, who all own their businesses. The example in this section will focus on their businesses, okay? Derek's brother Peter offers a strategic management consulting services as a sole proprietor. His business income fluctuates from year to year, but on average, he receives consulting income of $120,000, and he has related business expenses of $15,000 per year. He reports the net business income of $105,000 on his personal tax return. If Peter dies, his family will no longer benefit from his self-employment income. His business-related assets are minimal and includes some home office furniture, computers, and technology, all of which have depreciated in value since purchase. If Peter dies, he will be deemed to have disposed all of his business assets for their fair market value prior to death. because they have what? Decreased in value, this would not result in a capital gain. Okay? Wow. Corporation. So what if it's not a sole proprietor? What if it's a corporation? How does that work? A life insured who owns a private corporation may earn income in the form of salary or a taxable dividend. So when the life insured dies, his shares are deemed to have been disposed of at their fair market value. And this could lead to a capital gain, which, if the business is qualified for small business corporation, can be reduced by the lifetime capital gain exception. We talk about this clause, this lifetime capital gain exception clause in previous chapters, and it's to the maximum of 883,384. Okay, a corporation can survive the life insured. A corporation can survive the life insured and continue beyond death. And if the life insured shares have been, bequeathed to a beneficiary, he or she will continue to receive the dividend. As in our case study, Derek's sister Kimberly is one of two equal shareholders in InterSavvy Inc., a successful internet research company structured as a Canadian-controlled private corporation, CCPC. She receives an annual salary of $180,000 per year, as well as dividend income, averaging $50,000 per year. The company has 12 other employees, and Kimberly is president. Is confident that the business will survive even if she dies. However, she is worried about the tax implications of the deemed disposition of her corporate shares upon her death. Even after using the LCGE of 883 plus, she expects that the unsheltered taxable capital gain upon death will be in the order of 500,000. So she's also worried about how her family will manage if she dies and they can no longer benefit from the annual salary of 180,000. You see that? You see that dynamics. See, they are painting a different family dynamics. And this is where we come in to say, okay, when we look at this whole thing, then we have to put together a value proposition for the client. You see, the value proposition for an individual is different from a value proposition for a sole proprietor, and also value proposition for an individual who owns corporation is equally different based on the dynamics that we are seeing. Okay, so we move on to partnership. See, this thing is just partnership. Is there a way I can do this thing? What if I do this? Okay. Oh boy. What am I doing in chapter 9? How did I get there? This is me trying to figure out best way to do this thing. What? 9-2? Jesus Christ. Okay. How does this thing jump like this? Okay. So we're in 4. Well, I don't know, 4 point whatever we are, but I shall know where to start on partnership. Partnership. Where are you? Oh my goodness. This is Sorry, guys, bear with me. I will hope to figure out best ways to navigate through this, maybe by evening time during our evening class. And anybody that is expert on this, because I try to use my arrow down button. This one now jump on me significantly. When I scroll down, it jumps. So what do I do? This jump is so huge that, oh my God. Other loans, I think we're getting close now to where we were. Oh dear. Investments. What is this even going back? Oh, time of retirement. Okay, partnership here. I'll just scroll now. Okay. I want to believe this should be the next one. A life insured interest in a partnership is deemed to have been disposed of at its fair market value when the life insured dies. Again, a capital gain can result. However, it cannot be reduced by the lifetime capital gain exception. So the partnership doesn't have the opportunity to enjoy the LCGA benefit. You see, that's what happens when we tell people that in Canada, US, even dead people pay taxes because they say I really believe that you deem all your assets sold at the time of death for a fair market value. But there's what we call spouses rollover. You see, we talked about that in previous classes. Okay. All right. So let's look at our case study. Derek's brother Mark owns and manages several department building complexes in partnership with his two adult children, Aaron and Penny. Mark owns 50% of the partnership, while Aaron and Penny owns 25% each. Mark's share of profit last year was 140,000, and his will leaves his partnership interest to Aaron and Penny because this business is structured as a what? Partnership. It does not qualify for the LCGA exemption. And Mark is worried that the anticipated taxable capital gain of 400,000 upon his death will erode the rest of his estate, which he plans to leave to his wife, Michelle. See that? So we'll see how this affects the three different structure of businesses. All right, how the dynamics of a sole proprietor, partnership, and corporations. Okay, existing buy-sell agreement. If you're in previous classes, you would have gained an in-depth understanding of existing buy-sell agreements. A buy-sell agreement specifies that either the corporation or the other shareholders or partners to buy a deceased owner's interest in the company. The arrangement will specify that the purchase will be done at a fixed price or a price based upon a predetermined formula. The owner may not leave the interest to an heir in their will when the buy-sell agreement exists. Yeah. Okay, which kind of makes sense because if you have a buy-sell agreement with your partners in the company for them to buy your shares, you cannot still leave that same shares to your heir again. What your heir will get will be the proceed of that sale. Okay, a buy-sell agreement specifies that a share redemption plan is used with corporation. A share exemption plan is used if the corporation will buy the shares. Okay. A cross-purchase agreement is used if another shareholder or partner will buy the shares. The use of life insurance guarantees that funds will be made available to buy the shares. Okay, as in our case study. Because among these three brothers, the only person that have a proper structured corporations that we can talk about when it comes to buy-sell agreement is Kimberly, right? Derek's sister Kimberly and Janet, who is the co-owner of the InterSavvy Inc., are in the process of implementing a buy-sell agreement. This agreement specifies that if Janet dies, Kimberly will buy Janet's shares from her estate for $2 million and vice versa. In accordance with their agreement, Kimberly must acquire a $2 million life insurance policy on Janet's life to ensure that she has the funds to comply with the agreement if Janet dies. Again, you see, this can work in some places, but in some places where we come from, you better be careful who you enter buy a sell agreement with before it becomes something else, right? Anyways, now we move on to business income stability and amount. All right. Now, this similar to assessing the ability of the employment income. In assessing life insurance needs, the ability of the income. All right, so we'll continue with our chapter 5. So, oh, no, not chapter 5. I mean chapter 10 to bring it to a close before our next class. All right. So now we're talking about business income stability and amount. And don't forget, we are looking at evaluating different circumstances for insurance needs, and this time around, we've done the individual situations. Now we are looking at business dynamics, okay? Now, when it comes to business income stability and amount for businesses, similar to assessing the stability of employment income in assessing life insurance needs, the stability of income from self-employment should also be assessed, okay? Is income from the business reliable and regular? Is the business at risk of failing? This stability shows the ability to pay premiums, or alternatively, the need for insurance with flexible premiums. All right? If insurance is intended to support a family, its amount should reflect how business income might increase in the future due to business growth. Recall that if the job objective is to replace the business owner's income in the event of their death, then the income to be replaced is the net after tax or take-home pay, not the gross business income. All right? Now, let's look at retirement. When it comes to retirement often means that the need to replace employment income may end. All right? And then time to retirement. What is a time to retirement? What this means is that if somebody is 40 years old, then time to retirement is 25 years old. Many people, especially professionals, work past age 65. Therefore, their survivors may continue to have a need for income replacement until time the life insured is expected to stop work. Retirees may also need life insurance, especially if death will cause a retirement pension to be reduced for a surviving spouse. Like now, we go back to our case study again. In the case of Derek plans to retire at age 65. He would like to ensure that he has enough life insurance to replace his income for the next 18 years if he dies prematurely. All right. Moving on to retirement income sources. Wow. Well, the potential sources of retirement income should be considered when going through an insurance needs analysis. You see, so when I speak, to the fact that we, the first generation immigrants, we have a lot to put into consideration because oftentimes our retirement income sources are so limited, right? First generation immigrant, we don't have any grandparents that is, that is including us in their will, whereby we are expecting some estate sharing. And also we come here as an adult, we're just beginning our savings because you see, not that we don't have these things from back home, but how much can you bring? See what I mean? Now, pension plan legislation requires plans to provide the surviving spouse with a pension after the plan member dies. And its amount is generally between 60 to 66% of the amount that will be received by the plan member. Okay, so anybody that have worked here and you have a pension plan, so when in retirement, the person will be receiving pension. However, if the person died, the person's spouse will continue to receive that pension. But you cannot receive pension plan if you did not even work to contribute into the pension plan in the first place. See that? Now, there are different kinds of pension plan. There's one we call defined pension plan. So this situation of the plan member receiving 60 to 66%, this is in the case of defined contribution plan. If the plan member used the money to buy an annuity, then the survivor might not receive a benefit. Annuity is a completely different topic, and we will get to it. I think we'll be getting to annuity in sec fund. Yeah, I believe so. But in the course of this program, you'll definitely go through annuity. Then we'll move on to government retirement pension plans, pensions. If guys, I figured something out here. This is just on the side, not the way my document will be jumping on me. So now what I do is I open it in Google. So I didn't open the downloaded copy, I just opened the file that is on my drive. And that is running smoothly. When I scroll now, I'm not worried about jumping and stuff like that. I feel so happy. Anyways, back to our our topic. The government retirement pensions. If the life insured is entitled to receive CPP and old age benefits. Okay, the survivors may be eligible to receive survival benefit from both the Canada Pension Plan (CPP) and Old Age Security (OAS), in addition to his or her own CPP and OAS benefits. Okay, so these are the government retirement pensions. Okay, so this is from Government of Canada. These two, CPP and old age what? Old age assisted benefit or old age, no, what am I saying? CPP and old age security benefit, okay? Access to current financial situation. All these are things that we evaluate when people are seeking to get life insurance. Again, don't get overworked, or rather, don't get worked up thinking, oh my God, you mean I'll be evaluating all this? We have a software that we use for EFA. We just put certain information and we have an idea of what the needs, of the client is. But for the sake of the course and for the exams, we just have to go through, this route. So don't get worked up thinking it is this complicated. No, it's not. All right. Access to current financial situation. The life agent needs to get a clear picture of the life insured existing financial situation in order to identify assets that are available to meet estate needs, debts that may come up, that may come due at death, the amount of income the household receives now, and how this might change upon the death of the life insured. How much of current income is spent to meet current needs, and how much is saved, and how much cash flow is available to meet life insurance premium. So we move on to assets. So we've, we've finished talking about evaluation of insurance needs and all those blah, blah, blah fun stuff. But now we are moving on to assets. All right. What assets are available to contribute to financial needs? What asset does this person have? Assets are the property owned by an individual, either personally or in a form, joint tenants with rights of survivorship. A life insurance needs analysis should consider all property owned by the life insured that could be used to address estate objectives, may have a corresponding liability, such as mortgages against the home. So the asset itself may have corresponding liabilities, such as mortgages, and could result in a tax liability for the estate as well. So the agents must assess the value of all assets and differentiate between assets that could be sold to increase the survivor's base of capital and assets the survivor would prefer not to sell. Okay, for example, a survivor might have no emotional attachment to a rental property owned by the deceased. Selling the property could contribute significantly to the survivor's needs for income. However, the survivor might be very, very reluctant to sell a family heirloom clock despite its value in the tens of thousands of dollars. Liquid assets. So we move on to liquid assets. So when we talk about assets, so we have liquid assets and then we have fixed assets. So we're starting by taking a look at liquid assets first. A liquid asset is cash or property that can be quickly and easily converted to cash without any loss in value. For example, a checking account is a liquid asset. Liquid assets are needed to pay immediate expenses created by death, such as funeral and burial costs and personal debts. Liquid assets will also provide an immediate contribution towards income replacement. When there are not enough liquid assets to cover expenses, fixed assets such as real estate and vehicles have to be sold and sold quickly. Like in our case study, Derek and Becky used their tax-free savings account to hold their emergency funds. They each have about 25,000 in their tax-free savings account invested in a combination of money market funds and cashable guaranteed investment certificates, GIC. They have also $20,000 in their joint checking account. They only invest in their FSA if Derek receives a year-end bonus. Okay, so all those speaks to liquid assets. So let's move on to what? Our fixed assets. The fixed assets are valuable property whose sale will produce cash. They include real estate, vehicles, jewelry, expensive furniture, boats, etc. To attract a buyer and complete the sale quickly, the price of the asset may be reduced to less than its market value. In this case, it will contribute less to needs than previous planning may have indicated. Like in our case study, Derek and Becky jointly own a house valued at $550,000, ACB of 425. That is adjusted cost basis of 425,000. Derek has a new car worth 45,000, while Becky's used family van is worth 10,000. Derek also owned a cottage valued at 600,000, adjusted cost basis of 250,000 that he inherited from his father that he hopes to pass on to Jordan, Anya, and Robbie someday. He also owned 3 vintage cars that could easily be sold for a total of 72,000, and that would bring adjusted cost basis to 60,000, which he suspects Becky will sell upon his death. So all this, all what we saw in these examples, those are fixed assets. So we're moving on to investment assets. Investment assets generate and store wealth for future use and are created by using savings to buy corporate shares, bonds, rental real estate, segregated funds, mutual funds, and exchange trade funds, other financial instruments as well. Investment assets may be held in a registered account, such as Registered Retirement Savings Plan, RRSP, or non-registered account. Registered accounts may roll over to a spouse without creating a tax liability. However, non-registered accounts held in a joint form of ownership may also roll over to the other joint owner without a tax liability. Otherwise, if there is not a tax-free rollover, then the full value of the investment will be included in the final tax return for the deceased. Thus, it's important to record the adjusted cost basis and the fair market value of investment assets as well as the intended beneficiaries. We go back to our case study, and here, when we look at Derek has a non-registered investment portfolio in a diverse mix of equities. The portfolio has an FMV, that is fair market value of 280,000, and an ACB, adjusted cost basis, of 162,000. It generates after-tax income of 7,200 annually. He has 89,000 in his personal self-directed RRSP, and he has been contributing to his spousal RRSP for Becky. There is $36,000 in spousal RRSP, and Becky has her own RRSP worth 24,000. They only contribute to the RRSPs in years Derek and a bonus. Pension entitlements. All right. If the life insured or the spouse is a member of an employer-sponsored pension plan, current entitlements and survival benefits under the plan should be factored into the insurance needs analysis. Okay, Derek is a member of his employer's DCPP, that is Direct Contribution Pension Plan. To date, his account is worth 180,000, including his contributions and those of his employer, and accumulated investment income. Becky is a designated beneficiary of this account. If Derek dies before retirement, the funds will roll over into a locked-in retirement account, which Becky can access upon reaching age 55. So we take a look at our case study again. In Chapter 11, recommending an insurance policy will be using the information collected so far about Derek's and Becky's assets and is summarized in Table 10. Okay, so this table is just showing us that when we get to Chapter 11, where we'll be using, these people as an example, so they just tabulated this information here for us, okay? So the next thing we're going to be looking at is deaths, all right? Now, a life insurance, remember, what we are reviewing right now is assessing current financial situations of your clients in order to propose the suitable life insurance for them. Okay, so that is the topic we are discussing. We also need to analyze how much of debt is this client owing, right? A life insurance needs analysis must consider debt as well as assets. So we don't consider only assets, we also consider debt as well. Assets may be owned outright or a creditor may be involved. Debt obligation must be taken into consideration since they increase the amount of insurance coverage needed. As creditors may demand repayment upon the death of the borrower, you see what happens is that the moment somebody passes away, the creditors will get into panic mode, right? Because they don't know the level of assets this person have, whether this person have enough asset to cover, the liabilities, because there's so much unknown. So everybody is jumping in to get their own first, like first come, first serve kind of thing, right? So what will now happen? So as well, the payment towards the debt limit, the cash flow available to fund estate planning objectives. Just as assets are totaled for their contributions to net worth and income, also debt must also be added together. All right? So we move on to mortgage. How many properties does this individual have? Does he have them freehold or are there mortgages on them? Right? A mortgage is often the single largest debt of a homeowner. A mortgage must be discharged, paid off before the property can be bequeathed, whatever, okay? Spouses are usually co-owners and mortgages of properties. Co-owner, co, let me take that again, guys. Spouses are usually co-owners and mortgagees of property. Now it makes sense. A surviving spouse must have the financial ability to continue mortgage payments. Often, the life insured will want to ensure the surviving family can continue to own and live in the family home. And when going through the insurance needs analysis, we'll take this into consideration so that there is enough insurance to cover the amount owed on the mortgage. All right? Now, if adequate life insurance is not in place, a survivor might have to sell their home because they could not make mortgage payments. Right. So if adequate life insurance is not in place, a survivor might have to sell their home because they could not make mortgage payments. Okay. So we're going to look at the case study we have. In the case of Derek and Becky, they have just negotiated the 350,196 mortgage on their house, resulting in payments of 1,800 monthly over the amortization period of 25 years. Now, given Becky's current lack of income, Derek would like the mortgage to be paid off if he dies. Okay. Now, we've looked at mortgage, now credit cards and lines of credit. So, we in assessing current financial situation, we've taken a look at assets, we've looked at liquid assets, fixed assets, we'll look at investment assets, we'll look at pensions, entitlements, we'll look at debt, mortgage, and now we are taking a look at credit cards and lines of credit. Okay, so does this client currently owe money in credit cards or lines of credit? Well, insurance coverage should also be sufficient to pay off credit cards debt and all lines of credit. Okay, note that lenders may allow a credit card or line of credit account to remain open in the event of the death of the spouse if the account was held jointly. but may reduce the amount of available credit to reflect the surviving spouse's income only. Like in our case study that we have been using, the case of Derek and Becky that we have been using since, right? Becky do not have line of credit. And while they sometimes charge as much as 3,000 to their credit cards in 1 month, they usually pay the balance in full to avoid interest charges. Okay. Other loans. Is there other loans that this individual have? Let's take a look. Loans extended by creditors, such as a loan taken out to buy a car, must usually be paid off on the death of the borrower. A life insured may also have an outstanding demand loan, which is a loan for which the lender may demand repayment in full at any time. Demand loans typically have no predetermined repayment schedule and may only require the borrower to make interest payments. Demand loans are often used by investors to leverage their investment case study. Now let's go back to Derek again. You see, and I love the fact that they are giving us consistent example using the same Derek. So we are familiar with their story. We know their journey, right? It kind of makes sense, right? So in the case of Derek and Becky, Derek has a car loan with a balance of 41,000 with a payment of 620 monthly for the next 72 months. He would like this loan to be paid off if he dies. All right. Now, case study summary. This is the summary of our case study here right now. Now, in chapter, again, they have summarized our case study for us because when we get to chapter 11, we're going to be using this summary. All right. Let's move on to tax liability upon death. You see that? So, you see, when we talk to people, dead people pay taxes. Know that we are not telling them, to upsell them or anything, no. We're just stating the facts, all right? They are tax liabilities that emerges upon the decease of an individual, okay? A tax liability can arise upon death for income earned in the year of death, capital gains on property inherited by someone other than the spouse, probate taxes on property passed on through the will, except in Alberta in Quebec. So therefore, the life insurance needs analysis should ensure there is adequate life insurance coverage for tax liabilities. In our case study, Derek has a number of assets that have the potential to result in a tax liability upon them, depending on the designated beneficiary. Any non-registered property transferred to Becky can roll over without triggering a taxable capital gain. Similarly, registered plans such as Derek's TFSA, RRSP, and pensions entitlement can transfer into registered plans for Becky if he designates her as the beneficiary. Perhaps the biggest concern is the family cottage that he wants to pass on to the children. If he leaves the cottage to the children, either directly or through a trust, it could trigger a taxable capital gain of $175,000 based on its current value calculated as fair market value of 600,000 minus adjusted cost basis of 250,000 multiplied by capital gain inclusion rate, which is 50%. If Becky decides to sell Derek's vintage car collections, this could also result in taxable capital gain. All right. So we've looked at tax liabilities upon death. Okay. Now let's go into current expenses. What is the current expenses nature of this family? The spending patterns could change when the life insured dies. Less may be needed for certain expenses. For example, there may no longer be a need for 2 cars, and more may be needed for other expenses. For instance, if the surviving spouse must now pay for the cost of childcare that was previously provided by the deceased spouse, how expenses will change if the life insured dies should be taken into consideration when analyzing insurance needs. Okay. Again, so we look at their expenses here. Okay. Monthly expenses amount: spousal support 500, child support 1,000, mortgage 1,800, car loan 620, tax 480, home insurance 330, property tax, cottage insurance 400, utilities, car insurance, gasoline, food. See, there is life insurance, clothing and personal care, RESP, dining out, sports. You see, all these things come, total monthly expenses came to 8,560. Available cash flow. So cash flow is equal to net income coming in minus cash going out. That is your cash flow. So cash flow determines whether and how much cash is available for life insurance premium. It is calculated as net income, that is taking home pay minus expenses. A positive cash flow means the family can afford to increase expenses such as buying life insurance. Then again, in our case study, with Derek's take-home pay of 8,400 per month, they appear to have a small shortfall of 160 per month. However, Derek has indicated that until he receives his anticipated raise in 2 years, he is willing to use the after-tax investment income from his non-registered investment, which is 7,300 per year or 600 per month, to cover the shortfall, as well as any required insurance premium. While Becky and Derek both agree that it is important for her to remain home until Robbie is in school, they are looking forward to the day in about 6 years when she can return to work and bring in additional income. Okay, so all that we have taken a look at. But let's take a look at assets assessing existing insurance. So what if this individual have some insurance in place already? However, we need to evaluate what they have to see if there's a gap and then come up with a valid proposition to bridge the gap. All right. The next part of an insurance needs analysis requires the life agent to identify and assess any existing insurance in place. Existing insurance in place. Oh yeah, we are making progress. Okay. Now, individual insurance. All right. What life insurance does the life insured already own? This could be a combination of personal owned policies or coverage provided through a group life plan at work or through membership in an organization or association. In the if the life insured already has one or more individual insurance policies in place, then the life agent should note the following. Number one, is it 10? Is it 10 to 100? What is the face amount / debt benefits? All right. So again, on the right there, then what is the cash surrender value? The ACB. Who is the policy holder? All right. Because if it's the policy, if it's a group policy from work, then the policy owner is the employer. Okay. And then, yeah, term of coverage. What are the term of coverage? What are the renewability and convertibility options on these plans? And who are the beneficiaries of these policies? Okay. Are there riders and supplementary benefits on these existing policies? Okay. All right. Then how much is the premium? That's very key. and any limitations or exclusions. We need to know too, right? Yeah. So again, in our case study, when Jordan was born, Derek, who was 39 at the time, bought a 10-year term policy with a 250,000 level death benefit. Originally, the policy named Susan as the beneficiary, but when they divorced, he made his estate the beneficiary. So the policy has a double indemnity rider for accidental death and is renewable and convertible at age 70. It does not include any other riders. His current premiums are based on standard health rates and are $250 per year. The policy is due to renew in 2 years. The annual renewal rates at age 49, 50, and 69 are 1,125, 2,625, and 6,875 respectively. So let's move on to, this is individual insurance. So now let's look at, is there any existing business insurance in place? Let's take a look. Does a life insured have coverage through association with a business such as key person insurance or through ownership of a business? Note that business insurance may be structured so that the business is the beneficiary of the policy. Relationships to buy-sell agreement. Relationship to buy-sell agreement. All right, so let's move on. Just say that. Okay. So I need to play a little bit, right? A buy-sell agreement. You see, if you have caught up with all the videos, then you know that buy-sell agreement will not be new to you at this point, right? So a buy-sell agreement may specify that life insurance is required to be in place for each of the parties to cover the obligation for the surviving owners to buy the business interest of a deceased owner or partner. The insurance may be purchased by the individual shareholders or partners or by business itself. Types of policy. The types of policy. What type of policy does a business have? The buy-sell agreements can be based on term or permanent insurance. Term insurance will help minimize cost, while permanent insurance will ensure that coverage remains in place for an indefinite period of time. Also, with permanent insurance, the cash surrender value will be available to be used by the business. A policy used as collateral for a business loan can usually be termed with a period of coverage equivalent to the length of the loan. So we'll move on to ownership of policy and payment of premium. So in this case now, who owns the policy and who pays premium? Let's talk about that. All right. The policy holder for a business policy may be the business. Yes, under a cross-purchase agreement, the business owners buy insurance on the other person's, on the other owners personally. A key employee covered in a split dollar arrangement will need to determine which portion of the death benefit, the face amount, and any value in excess of the face belongs to him or her and will be paid to their personal beneficiary. If the business wants to protect itself from the loss of a key employee while also offering the employee access to a tax deferred investment vehicle, then the business will own the face amount and the employee will own the cash value. In this case, the business share of the premium will be tied to the reasonable cost for comparable term insurance coverage, and the employee will pay the balance of the premium. All right, we move on to group insurance. We are making progress, and I like that. As noted above, group insurance can contribute a death benefit. Yes. All right. I'm not going to start, I'm tempted to explain group insurance, but I'm not going to do that. We've already done that. Okay, guys? All right. The life insured may be a group plan member, or they may be covered as a dependent. All right. Let's talk about face amount. What is the group plan face amount? Coverage provided by the group plan must be analyzed for its basic death benefit. All right. Possible increase in the basic benefit due to a link to salary, or by length of service, or by accidental death. Any possible decrease due to age should be put into consideration as well. And options for an increase in the coverage, all these should be put into consideration. So we are moving on to policyholder and conditions of membership when it comes to group insurance. Sorry. Okay. Now, it is important to note that the group plan member is not the policyholder of the group policy and therefore has no control over it. Benny, okay? We'll discuss this in details. Whether premiums for the policy will be paid, whether the policyholder will continue to provide the plan as a result of changes in personal circumstances or in the group plan, the life insured may fail to meet the conditions for continued membership in the plan, resulting in the death benefit is no longer available. Wow. End dates and convertibility. End dates and convertibility. Wow. Let's talk about this end date and convertibility. All right. When we group coverage ends, that's right. When does group coverage ends? There may be an end date to coverage under a group plan. For example, if coverage ends at retirement. You see, that's why sometimes I meet people and they say, oh, I have coverage from work. My work will give me a... I say, yes, but you cannot be there forever. Even if you want to occupy till I come, but you will still retire. You see? Now, conversion to a personal policy with equal or higher or lesser coverage may be feasible if the plan is terminated or the plan member retires. It may be possible to convert spousal or dependent coverage as well. Review section 6.6 case study. So chapter 6.6. So we dealt with this in chapter 6. And I used my own personal experience, in that chapter. So go check it out if you haven't. And you shouldn't even be in chapter 10 if you've not even gone through chapter 6 anyways. All right. Let's take a look at our case study again. Derek has a group life insurance equal to one time his annual salary through his employer's group plan. It is convertible to the same amount of individual term coverage upon leaving the plan. Vulnerability. Okay, what are the weaknesses of the group plan? Let's talk about that. Its many limitations must be taken into consideration. Foremost among these is the limited amount of coverage, the lack of control for group plan members, and whether the policy holder might discontinue the plan. In addition, although coverage is usually convertible to an individual insurance policy, the premium upon conversion are not guaranteed. It happened to me. All right. Government benefits. Let's talk about that. I'm just loving it. I'm just vibing, I'm just vibing. This topic is smooth. I don't know if you guys like, because I teach this chapter to chapters. Some chapters are not smooth, but this one is smooth. It's flowing, but when we get to those calculations, oh my God. Anyways, let's keep it moving. All right, government benefits. Let's talk about this one. While government benefits upon death are not usually sufficient to address all of an individual insurance needs, they are still worth noting. One of them is Canada Pension Plan, CPP, survival benefits. You see, CPP survival benefits. Upon the death of a person who has contributed to the Canada Pension Plan, provided that the person meets CPP eligibility retirement, then the person's estate or one or surviving family member may be eligible to receive one or more of the following benefits. Number one, death benefit, that is explained here. Survivors' pensions, that is explained there. And any other one? Children's benefit, that is explained here. Okay, now the person's estate, that is the surviving spouse and children or their guardians, must apply for these benefits. They are not paid automatically. Okay, Derek has been making the maximum CPP contributions for about 20 years and meets the eligibility requirement for survivors' benefits. So moving on to Quebec Pension Plan. What is Quebec Pension Plan doing here? QPP. What is the difference between CPP and QPP? I don't think this is not worth our time. Okay, there's nothing Quebec in our exam. So me, I will feel comfortable to jump and pass this one. Are you bringing Quebec and this thing for me? Whereby I'm not writing exam for Quebec, whatever. But hey, guys, just for knowledge sake, you can just read it, right? Okay, so let's move on to old age security, OAS. You see, I intentionally, every time I come across any of all this abbreviation, I intentionally say the full meaning so that it sinks in. You guys are familiar with it, right? So that in the exam, if you see OAS, you won't be wondering, is it Organization Association of Clinical? You know what I mean, right? Okay. So let's talk about this old age security allowance for surviving spouse. Canada's old age security program provides for an allowance to be paid to a low-income surviving spouse of an old age security pensioner, provided that the surviving spouse is between the age of 60 and 64. The maximum allowance is 1,388.92 per month as at 2020, but it is reduced by $1 for every $2 of other income. And once the recipient reaches the maximum age for the receiving the allowance, she will begin receiving her own benefit. Wow, that is self-explanatory and straightforward. So let's talk about workers' compensation, WCB. By the way, I need to, anyways, that's on the side note. Let's talk about WCB. Workers' compensation programs are provincially delivered programs to protect employees from financial hardship due to injury at work or occupational disease. Employers are required to pay premiums into the program at rates based on their own risk and safety records in comparison with provincial averages. Each province has their own WCB board, and the federal government has a separate WCB for federal employees. The benefits paid to the surviving spouse or children can vary widely from jurisdiction to jurisdiction, but typically included the following types of payment: funeral costs ranging from $4,000 to an unlimited amount, and immediate lump sum ranging from $2,000 to $100,000, monthly pension for the surviving spouse and or children that range from as little as $400 per month for a child to 85% of the deceased net earning for surviving spouse with children. It is important to remember that These benefits are only payable if death is caused by work-related accident or illness. Okay, kind of makes sense. All right, identify client's priorities in the event of death. Let's talk about that. All right. So far, this chapter has focused mainly on facts and numbers. However, the agents must also understand that the qualitative questions are as important. Family lifestyle. Let's talk about family lifestyle. Planning should ensure that the lifestyle enjoyed by survivors will not be diminished by death of the proposed life insured. Whether the husband, wife, partner, or parent, some of the quality of life issues to be considered includes how and where will children be cared for? Is a surviving spouse likely to be dependent or will he return to work? Is there a need for a surviving spouse to update their education and training to become employable? Will the family continue to live in its principal home? Should the mortgage be paid off? Is there a second home or homes to which the family is attached? Should planning be based on keeping that home in the family? Is there a family business with plans to pass it on to children? If so, how will the tax liability resulting from the deemed disposition on debt be paid? Let's take a look at our case study again. Derek wants Becky to be able to carry through with their plans to have their stay at home until Ruby is full age full time. At that time, he knows she will be ready to return to work, but her earnings will not be enough to maintain their current standard of living. Thus, he would like to ensure that she has enough money to replace his income for the next 6 years, plus enough to supplement her anticipated income to the same level until retirement at age 60. He also wants all their debts to be paid off if he dies. Derek wants to fulfill his commitments for spousal and child support for Susan and Jordan. And while he believes Becky will honor his wishes, he will prefer not to have to involve her in these payments after his death. Finally, Derek wants to ensure that the title to his cottage can pass on to his children by having enough funds in his estate to pay the income tax that will result upon his death. Wow. And finally, let's talk about final expenses. Okay. You see, these final expenses is not a question of if, it's a question of when, right? Funerals may be small, modest affair, or quite expensive. The agent needs to verify with the client the type of funeral the life insured would like to have in order to ensure funds are available and sufficient to meet the desired type. In our case study, Derek does not want an extravagant funeral. He believes 20,000 would be more than adequate to cover his funeral expenses. Plans for the future. Let's talk about this one. As part of the insurance needs analysis, people may want to think about the future. What events are likely to occur and add financial strain? For example, the cost of post-secondary education, formal wedding, and long-term care are three considerable expenses. If the life insured has died before this event, will the survivor have enough money to pay or contribute to their cost? The death benefit may also be required to pay large lump sum as legacies and for charitable givings. In our case study, Derek and Becky believe it is their job to prepare the children for adulthood by helping them afford a quality post-secondary education without necessarily covering the entire cost beyond that. They have no intention of providing the children with capital for any home or business. They already contributed to an RESP for each child, and as long as he can ensure that his income will be replaced if he dies, Becky can continue to make these contributions. He believes that another 10,000 for each child will be sufficient to cover their educational expenses. If possible, Derek would also like to make a charitable donations of 100,000 to his local hospice if he dies, because this organization recently provided excellent end-of-life care to his father. And that brings us to the end of chapter 10. Thank you very much. And we will continue from chapter 11 in the next class. Bye.